Welcome back to the Income Generation, the show where we provide information for that critical period in people's lives when they're either in or approaching retirement. Each week I help you discover useful actions that serve to make this journey much easier. I'm David Scranton, your host. I look forward to this opportunity each Sunday to share with you insight and expertise that I use in my own investment management practice. These are insights that you can either use as food for thought or decide to act upon while building or managing your finances, as well as the money that you'll need for retirement. Today on the Income Generation, the focus will be completely on income-generating investments as I answer one of my viewer emails. I've gotten a number of these calls and emails and requests to do more on the subject of bonds and fixed income. This particular email is from Mickey in the Villages in Florida. She writes, Dave, I watch the Income Generation every Sunday. I've learned a lot about why the media pushes stocks and mutual funds, as well as the risk of history repeating itself with a long stock market sell-off. However, you haven't given a lot of detail about income-based investments. My husband and I have a portfolio of bonds that has treated us well, and I thank my financial advisor for that. As you should, Mickey, be thankful for that. But she continues to write, but there's a lot that I don't understand, and I hate to keep asking him. Will you be talking about things like coupons, ratings, municipal bonds, and how they're priced in one of your shows? This could really be helpful to us and I'm sure other viewers. And that came from Mickey and Skip in the Villages in Florida. Well, first, Mickey and Skip, I hope you're having a great day in the Villages. I always have a fun time visiting friends and clients when I'm there. My office is actually about 3 hours south of you, so I get up there whenever I can. I've been warning the Income Generation about some of the more common investments people have been taught to go to when investing for retirement. I've been suggesting that investments for those close to or in retirement are those that best serve the retiree's purpose. Most often those investments are the ones that can be relied upon for a predictable and steady income stream. Investing for the purpose of income is crucial because there isn't anyone who has invested in a stock, mutual fund, or precious metal for that matter, who could possibly know what it's going to pay back to them in 5 years or 10 years or even next week for that matter. So today this show is completely dedicated to investments that are much more reliable and predictable. Those where the company has a contractual obligation to you and a promise to pay you a specific amount. These are the income investments, for example, that my firm, Sound Income Strategies, specializes in utilizing to help clients. They keep those born before 1966 sailing into and through retirement focused on the things that really matter. In today's market breakdown, you'll discover extremely useful facts that most financial advisors don't even know. I'll reveal how, for example, my clients at Sound Income Strategies benefit from interest rate differences between the various security types. We'll talk about the reasons bond funds may be one of the worst investments for you, as well as how to make the most of the guarantees on individual bonds, as well as bond-like instruments. I'll also discuss how to decide if investing at today's historically low interest rates is a good idea. My guest a little bit later today is one of the most brilliant minds in fixed income investing and global economics. Mohamed El-Erian joins me for a one-on-one where we'll all learn together exactly what this chief economist of Allianz and former CEO of PIMCO expects from interest rate moves, as well as why America is the preferred nation of international investors. Then, in our News and Views segment, Morgan Thompson and I will sit down to discuss nuances of different income-generating investments. It's not as complicated or overwhelming as most people think. In fact, once you know the difference between the many variables and choices of income securities, it can almost be likened to ordering an ice cream sundae. It's this simple. If you and a few of your friends went into Baskin-Robbins for a sundae, you'd probably not be overwhelmed by the choices put in front of you because you've ordered sundaes before and you know how ice cream shops work. So you'd appreciate the benefit in having many choices rather than being intimidated by them. It's the same with fixed income. But if you had never been in an ice cream parlor and weren't familiar with sundaes, you might find the decisions to be complicated and overwhelming. Your head would spin with the 31 flavors you know little about. First, you'd have to pick what size you want. Then you'd have to decide whether you want 1, 2, or 3 flavors. For those getting 3 flavors, they have almost 30,000 possible combinations and permutations to choose from. Then, of course, there are toppings. Do you want chocolate, hot fudge, maybe caramel? Then sprinkles or no sprinkles, maybe nuts or strawberries, with or without whipped cream, and the last decision is, of course, the cherry on top. This is mind-boggling if you think about it. And in any given week, it's unlikely that any 2 people get the exact same sundae. But they're all custom ordered and satisfy different customer wishes. My point is that for those familiar, thankfully you're not confused by all the varieties. It allows customization to no one's taste but yours. So after the benefit of promise to pay income in return of principal, I'd say variety is the second most positive thing about investments in bonds and fixed income-based investments. Once you have an understanding of a few of the basics we're covering in today's show, investing your retirement money with the purpose of income can be just a bit more complicated than deciding on dessert. And that's how most of my clients view retirement. It's life's dessert. I won't promise that by the end of the show, building your portfolio will be as easy as ordering a sundae at your local ice cream parlor. But you'll no longer be intimidated and might even be more knowledgeable than your current financial advisor. If you have money in stocks, bonds, or even bank CDs, you're in for a treat with today's show about fixed income investments. Now, it may not be quite as exciting as picking from 31 flavors of ice cream, but when done right, it can provide you with enough financial comfort that you do even more of the things that you enjoy doing. Stay with us because we'll be right back with our market breakdown. During the commercial, you may want to text your advisor and make sure that he or she is also tuned in to Newsmax Television, the income generation.
Read David J. Scranton's groundbreaking new book, Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. Learn the truth about Wall Street, the financial media, and the secrets they try to hide from everyday investors. This isn't just another book about investing. Working Americans who have lived through 2 major stock market crashes and the worst financial crisis since the Great Depression in the past 16 years don't need another book about investing. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Stop planning for retirement with your fingers crossed. Read Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Available now.
Fixed income securities. What are they? How safe are they? Can you get paid enough in this market? And when is the best time to invest? First, rather than use my own definition, I went to investinganswers.com and I'm giving you their exact definition. I could not have made it any more concise. They say that a fixed income security is an investment that pays regular income in the form of a coupon payment, interest payment, or preferred dividend. And they give this example. Fixed income securities provide periodic income payments at an interest or dividend rate known in advance by the holder. The most common fixed income securities include treasury bonds, corporate bonds, certificates of deposit, and preferred stock. I would also include a couple of others in that, but we'll get to them later in the show. People who invest in bonds and other fixed income are typically people who want income. For these investors, knowing what they're expecting to receive is a huge benefit. You see, unlike stocks or mutual funds, bonds have 2 important guarantees. Individual bonds I'm referring to. The first and most obvious is the fixed rate of interest for the term of the bond, which is between now and the time it matures. It means you can depend upon a level, predictable income stream. In previous shows, you've heard me call this a bird in the hand. The second guarantee by the issuer is probably even more important to many income generation members. When a bond reaches its scheduled maturity, you're going to get paid according to the issuer's contractual obligation to you. This is why my firm, for example, puts so much emphasis on creditworthiness and risk assessment in addition to watching credit ratings and financial ratios. At my company, Sound Income Strategies, we not only look at ratings by the top 3 rating agencies, but we also dig down even deeper and do our own analysis before entering into a transaction. The safest bonds, of course, are U.S. Treasuries. They're backed by the full faith and credit of the U.S. government. In fact, they have the exact same financial banking as the cash that's sitting in your pocket right now. That is backed by the U.S. Treasury, Federal Reserve. They're considered riskless, partly because if they're no good, it also means your U.S. dollars are also no good. The next in the safety spectrum is generally considered with reasonably high safety are municipal bonds. Many of these are backed by the full taxing power of the state, city, or county. These are issuers that don't often go out of business or get repossessed. Although it's rare that a municipal issuer has problems, we still pay close attention to what rating agencies say, and we do our own analysis on any of these that we may want to add in our current client portfolios. In fact, I believe that all advisors using bonds should have chartered financial analysts or CFAs on staff doing further research, digging down and looking under the hood of anything that their clients own, especially in the fixed income world. Corporate bonds are considered next in the risk spectrum. Here is where you really have your 31 flavors or so to deal with. There's a whole scale of credit ratings from 3 different rating agencies, everything from excellent to what's often referred to as junk. These nationally recognized statistical rating organizations evaluate companies based upon the company's ability to pay, the strength of their management, and the ability to raise money in the capital markets, as well as many other factors. The most important guarantee that I mentioned earlier is that at maturity, you are repaid your exact principal amount that you knew and agreed upon when you initially invested. It's important to note that bond funds don't do this. Bond funds don't mature, and therefore, technically, they're not a fixed income instrument. Essentially, they're a legal corporation that contains bonds, but the corporation itself trades as an equity. Because this corporation itself doesn't ever mature, you don't know what to expect to receive, and you give up control over your money. I cannot stress enough that, in my opinion, you should avoid bond mutual funds if you're at or near retirement. You should know that if you own bonds in your portfolio and have an unexpected need to raise cash, you can do so. You can sell a bond before maturity. In fact, investment-grade bonds are very liquid, and they're actively traded on the open market at negotiated prices. The bond market itself is much bigger than the stock market. As we've said on the income generation before, as rates go up, the general rule is that the value of your bond goes down. But does this mean you shouldn't invest in bonds at all right now when rates are at a record low? Well, we'll discuss that in a minute, but keep in mind that for every day that you wait to invest and you have cash sitting on the sidelines, you're earning no or very little interest. And each day that you wait is a day that you're holding on, gambling, hoping and praying that interest rates in the future go up. Why? Because the longer you wait, then you'll need even a higher rate in the future to cover the cost of waiting. Plus, if you're a person who plans to hold these bonds to maturity, as many of our income generation members are, then the price risk, the change in prices when interest rates go up, really shouldn't affect you. And this is no different from an asset like a bank CD. You don't get statements from your bank telling you that your CD is worth a bit less right now because if you sold it early, you'd have to sell it at a loss. They just assume you're going to hold it to maturity. If today's income-based investments accomplish your income needs, then waiting and hoping for higher rates may prove detrimental. There are folks in Japan who are now living with low interest rates for the past 25 years. And a few weeks ago, the Bank of Japan lowered some rates to below 0. So waiting can be risky. This may actually be the best time to invest in fixed income that we'll ever see over the next decade. And here's why. Most financial advisors don't really understand fixed income investing beyond the basics of the fact that when interest rates go up, fixed income investments tend to drop in value. One nuance, for example, that many don't understand is called risk premium. I don't hear anyone talking about it, but as other advisors catch on, rates on higher paying securities may come down with increased demand. Let me give an example. Back in 2007, there were a particular class of fixed income securities that we at our company, Sun Income Strategies, were using to help a lot of our clients. And that class of fixed income securities is paying 6.5% per year. At that time in 2007, the 10-year U.S. government bond, the 10-year Treasury, which is generally considered to be a risk-free investment if held to maturity, was paying 4.75%. So the difference between the risk-free and this other class of investment I'm referring to was 1.75% per year. That means that investors required only an extra 1.75% interest to go from something that's completely backed by the government and has no default risk to something that had a little bit of default risk. That 1.75%, that differential, is what we call a risk premium. Now, the reason for that was because at that time in 2007, people were really confident. So they thought, okay, to go from something that's risk-free, that has risk, I'm not going to worry too much. I only need a little bit more interest. Now fast forward to today. Today, the same 10-year risk-free, theoretically risk-free U.S. government bond is paying about 1.75%. That rate is dropped by 3 percentage points. But the interest that's paid on this particular class of fixed income security I'm referring to today has only dropped by 0.5%. It went from 6.5 down to 6. So wait a minute. The risk-free rate went from 4.75 to 1.75, dropped by 3%. But this particular class of security only dropped by 0.5%. Why? Because when interest rates were dropping, it's because people are concerned about the markets and they have fear. And as a result, investors decided that they needed to get more interest to justify the extra risk of going up and above U.S. Treasuries into any other class of investment. So the risk premium expanded from what was 1.75% to what now is 4.25%. So when you talk about the concept that interest rates go up and fixed income securities drop in value, most advisors who don't specialize in fixed income securities always look at the 10-year U.S. Treasury and they use that as a proxy. But what they don't realize is that risk premium that we're discussing today is something that has an offsetting factor. Why? Because just like when the 10-year Treasury rate dropped a lot and the rate on this particular class of security just dropped a little, it's completely possible that the 10-year Treasury rate goes back up by 3 percentage points and the rate on this particular class of security only goes back up by 0.5%. So in some ways you could think of this ever-expanding risk premium and shrinking risk premium as something that softens the blow when bonds decrease in value. For example, imagine the difference between jumping out of an airplane with no parachute versus jumping out of the airplane with a parachute. Now, I don't want to say, for example, for a minute that these class of bonds have no risk, but the reality is that the risk premium acts kind of sort of as a parachute that helps soften the drop. And unfortunately, most advisors really don't understand this. Instead, they're out there simply robotically quoting that if interest rates go up, bonds go down. But they're looking at oftentimes the wrong interest rate that does not particularly apply to that particular investor. Although business news has focused recently on stocks and mutual funds, which are what I call the chocolate and vanilla of the investment business, I'm going to show you that the income markets have many more flavors from which to choose, and they look more appealing than ever before for retirement-based accounts. Why? Because the easier to understand chocolate and vanilla stocks and mutual funds appear to be on the verge of melting. That's why my firm specializes in the much broader yet more conservative variety of income-based investments. Next, we go one-on-one with Mohamed El-Erian, and we'll talk about interest rates, bonds, the markets, right here on the Income Generation. If you're not using someone who's well-trained in fixed income and you're born before 1966, it may just be time for you to break up with that advisor and move on. I would suggest someone who will care for you through these important years of your life. If you need help finding someone, call or write us. I'd also like to remind you of the special report entitled The Income Generation. This is available free to you, our loyal viewers, online. If you haven't downloaded your report, pick it up after the show. you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation, again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. Mohamed El-Erian is the Chief Economic Advisor at Allianz. His new book is titled The Only Game in Town: Central Banks, Instability, and Avoiding the Next Collapse. He's chairman of President Obama's Global Development Council, a contributing editor to Financial Times, and the former CEO of PIMCO. He holds a master's degree and a doctorate in economics from Oxford University, and also authored the bestseller When Markets Collide, which won the Financial Times and Goldman Sachs Business Book of the Year. You can manage as a fixed income advisor. This is someone for whom I have a lot of respect and have followed over the years. So it's a great pleasure to have you on our show today, Mohamed.
Thank you, David. Wonderful to be with you.
Listen, first, I want to talk about Janet Yellen in her testimony just a little while ago on February 10th before the House Financial Services Committee. She talked a lot about a slowdown in China, which of course we're all aware of, which is helping to create downside economic risk in our economy, as well as other global economies. Current inflation measures suggest very little pricing strength and very little room for long-term interest rates to increase. So my question is, if the yield curve remains as flat as it has been, or even becomes inverted, will banks and insurance companies resume their previous problems, in your opinion?
So it depends where they're starting from. There's no doubt that banks in particular are facing three elements that are developing a perfect storm, particularly in Europe. First, the interest rate environment. Like you say, we not only have interest rates coming down, but the curve is flattening and could even invert, which means they earn less. Second, those who've lent to the commodity sector and the energy sector have a quality issue on their portfolio. So there's concerns about the quality of the loans they've made. And third, and this is also important, the regulatory environment has changed. So investors have less confidence that if something really goes wrong, there will be support for them. Put these three things together, and this means pressure on banks in particular. And in Europe, it means huge pressures on banks.
Yeah, I agree completely. It makes a ton of sense. And in general, central banks have come under a lot of criticism for their drastic manipulation of markets over the last few years. Question is, will the Fed and or other central banks lose their resolve to squelch this volatility in their particular local markets in the future? Or do you think this practice is
So we have two developments. Yeah, we have two developments. And you're right, central banks realize that they're under criticism, but it's important to remember they didn't do this by choice, but they did this by necessity. Why? Nobody else was stepping in. They have political autonomy, so they felt morally obliged to step in even though they didn't have the right tools. With time, when you don't use the right tools, the collateral damage becomes significant, and that's where we are today. So we're seeing two trends. In the case of the Fed, it is less willing to continue doing this. In the case of the other central banks, the European Central Bank, the Bank of Japan, the People's Bank of China, they're still willing, but less able, they're less effective. So the central bank community as a whole is having a lot more trouble continuing its policy of repressing volatility and intervening with markets.
It's interesting, after the Fed hike in December, I was on a panel on Closing Bell that same day, and I remember that when the Fed statement said that they'd be cautiously raising rates throughout 2016, it seemed completely unlikely to me. And you know, the FOMC, let's face it, certainly has access to more information than I do and almost any other entity. Do you personally think that they believed what they were saying at the time, or perhaps were just trying to create a lot of optimism and self-fulfilling prophecy of sorts?
So one issue with the Fed historically is that they tend to concentrate on domestic developments. And if you were to look at the US economy in isolation, you would argue that yes, it can support 4 interest rate hikes, which is what they signaled at the time. But if you look at the US economy in the broader context, then you start getting worried. Why? Because you cannot be a good house in a poor neighborhood. And what's happening? The global environment is getting more risky. There's less economic growth internationally, and there's more financial volatility. So if you look at the US in the context of what's happening outside the US, it's very hard to see how they're going to hike interest rates 4 times.
Yeah, well, that's a conversation that you and I could probably spend hours having if we weren't limited by the television show. Tell me, should small investors who are looking for income today, should they be sitting at home waiting for rates to come back up? Or do you think with the global economic weakness we're seeing today that rates are going to stay low for a long time, so they might be better off just putting money to work in fixed income now versus waiting?
So a lot depends on your starting position. So a few things that investors should keep in mind. One is this volatility will continue. It is not going away. We're coming out of a period of unusually repressed volatility, and now we're going to have payback. So the first thing they should be ready for is wild volatility. Intraday, intra-week, they're going to see a lot of very strange things happening as the system starts to normalize again. The second element they have to remember is when they buy fixed income, they're buying at least 2 very distinct risks, as you know. One is interest rate risk, and the other one is credit risk.
Of course.
And they have to be careful on the credit risk side. Third, patience is really important. As markets get dislocated, good names and bad names go down together. So a patient investor will have opportunities to pick up good names at low prices. I would be cautious. I would be very measured at this point. I would value the optionality that cash gives me. And I would make sure that I'm not overexposed to volatility.
You and I seem to agree on so many fronts, but maybe that's because I was smart enough over the years to follow you and to learn from you. So stay with us. We have to take a commercial break, and when we come back, we're going to talk about Mohamed's new book and some predictions and things that are going to help you manage your money better. We'll be right back. This is fun. This is great. 3, 2, 1. But I'd like to take a few seconds and tell you why I decided to write the book entitled Return on Principle. Basically, it all boils down to this. Let's face it, you deserve to live a happy retirement. It's as simple as that. But for many, the subject of money, finance, and math is complicated. Here's a fun fact. Many Americans claim that they'd much rather clean a toilet than calculate a tip in a restaurant. Thank you, I guess. But it doesn't have to be that complicated. Using the 7 core values I outline in my book, you too will be able to build a life based upon the right core principles. Cut. Return on Principle isn't just a book about financial investing, it's about investing in your life. I know for a fact that you're going to love it. Okay, now it's just getting a little weird here. Welcome back. As a fixed income nerd, you can imagine that I have an incredible man crush in a way on our guest today. Our guest we're talking to is Mohamed El-Erian. He's the Chief Economic Advisor at Allianz. And now we're going to talk a little bit about his new book, The Only Game in Town, Central Banks, Instability, and Avoiding the Next Collapse. Tell us, Mohamed, what can our viewers learn from your new book? Things that they may not be hearing from a traditional financial advisor.
So the main point of the book is that all that we are seeing in terms of market volatility, in terms of negative interest rates in Japan and Europe, in terms of this very strange blame game between oil and stocks, all these things are part of a much bigger story. And the story is actually quite a simple one. The road that we're on is ending. We will no longer be able to repress financial volatility. We will no longer be able to maintain low but stable growth. We are going to tip. Within the next 3 years, the system is going to tip. Now, what's hard is that there are 2 possibilities. There's nothing predestined about where we go. We could either tip in a much better place if our politicians respond, or alternatively, it's about recession, it's about huge financial instability. So investors have to realize that we are entering this T-Junction, what the British call the T-Junction, the road ends. And they have to think about the asset allocation accordingly, which means doing things differently, David.
How about oil? What's your take on what's been happening lately with oil? This is kind of sort of unprecedented.
Yeah, and it's amazing to think that low oil prices have gone from being viewed as a blessing to being viewed as a curse. It's not just a supply and demand issue. If it was just a supply and demand issue, oil wouldn't be where it is today. It'd be higher. It is also that the oil market has lost its seatbelt. It has lost the swing producer. The notion that OPEC and Saudi Arabia would cut production in order to support prices. So the market right now is completely unhinged. Over the long term, if you ask me where's it going to be in 12 to 18 months' time, I'm pretty sure it's going to be higher. But over the short term, we're going to see enormous volatility continue.
Do you think it's another deflationary signal? The fact that oil's been dropping, not as far, because a lot of this is because of the unhingedness that you just described. But in general, do you think it's a deflationary signal as I do?
Yeah, it is a deflationary signal with one qualifier. It has a positive income effect. Why? It's an immediate tax cut. You go to the pump and you have more dollars in your pocket after you filled your tank. So this is an immediate tax cut. It has a deflationary price effect, but it has a positive income effect. The question, as you rightly noted a couple of minutes ago, is are households confident enough to spend this windfall?
Correct. In the last minute we have together today, I'd like to, time flies when you're having fun. I'd like your take on what's happening recently. A lot of advisors, traditional advisors, are saying don't invest in fixed income today because interest rates can only go up. But they miss the whole concept, the offsetting element, which is the risk premium spread. And we just talked in the last segment about risk premium spread. So do me a favor, tell our viewers what your take is on that.
So my take is to be very careful about the risk premium for now. We are going to see pressure. There is no patient capital to step in and stabilize risk premiums in general. But this will create opportunities. Why? Because you get this awful thing called contagion, where good names and bad names are lumped together. So be patient. There will be opportunity to pick up fixed income where the risk premium has moved excessively. So be patient, but this is not an immediate opportunity. This is one that's going to develop over time.
Yeah, and at least investors saw that only 7 or 8 years ago, so it shouldn't be a total surprise. But you're right, the contagion does occur and is an issue for investors. So it's been a pleasure today. I want to let you know that I don't think any less of you for the fact that you gave me the 50-50 answer. Sometimes it is truly 50-50. So thanks a lot for being on our show today.
Thank you.
All right, stay right with us. We're going to take a commercial break. We'll be right back talking more about how you can earn more income conservatively in your portfolio. We'll be right back. Near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation, again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation.
So Dave, if I understand your metaphor, the stock market and mutual funds, which are like the income generation's old standbys, let's call them vanilla and chocolate, they don't seem to offer much more. And the supposedly complicated fixed income market, if you gain a little bit of knowledge, it won't overwhelm you, and it's much more satisfying. You compared it to 31 flavors and up to 3 scoops to build a sundae with.
It's much easier than people think. It really is, once they get the basic knowledge. Okay. The biggest problem, though, with fixed income investing is that there are fewer places you can go to actually access the information that you need to make decisions. Whereas the information for doing research, just low-level research on stocks and mutual funds, is everywhere.
Now, I know there are different rating agencies. Can you explain a little bit more about the different ratings, or I should say, the different flavors available?
Different flavors, absolutely. The rating agencies, the 3 major ones, are Moody's, Standard & Poor's, and Fitch. And just to use one for an example, they'll have A, B, C, D ratings, but then they break it down even more. So they'll have AAA, AA, single A, triple B, double B, single B. Then they break it down even more, just like when you were in school, they'll put plus and they'll put minuses before each grade.
Like a report card.
Just like a report card. So you have many different grades, and the idea of this is to help the average investor determine the financial stability of the underlying issuer of the bond. Again, specializing in this type of thing, we go beyond that and dig a lot deeper, But for the do-it-yourselfer at home, they should at least be able to understand those basic financial stability ratings and be able to interpret them.
Okay. Well, you've mentioned municipal bonds. I know that some of them save me from paying taxes on the interest payment.
Well, to use our ice cream analogy, I like to say that it's kind of like for those who are lactose intolerant, or in this case, those who are income tax intolerant, perhaps like yourself. And the reason for this is because many types, not all, but many types of municipal bonds they generate tax-free interest to the bondholder.
Okay.
And if you live in a state where they actually have income taxes, one thing we don't have to worry about here in Florida, but if you live in a state where they have income taxes and you buy a bond that's issued from the state in which you live, then it's actually tax-free on the federal level as well as tax-free on your state level.
So sticking with our sundae analogy, because I'm liking this, it's a lot of fun.
Sure.
If we were going to create a sundae just for me, I know I need hot fudge, I need cherries, whipped cream, little walnuts. I like a lot of diversity. So if you were going to create a portfolio for me after bonds, what are some of the other ingredients you'd include?
Well, there are several. For example, when you're talking about bonds, you're talking about some that are callable, some that are convertible. If you get out of pure bonds into the world of what I call bond-like instruments, you have things like preferreds, BDCs, or even REITs, REITs.
Okay, well, this sounds like a lot to cover. Can we talk about them one at a time?
Sure.
Okay, well, you know I like convertible cars, so let's start with convertibles.
Convertibles, okay. Convertible bond, for example, is kind of a hybrid between a stock and a bond. So it's something that the investor, if they want to give up a little bit of interest with a non-convertible bond, they can actually have the ability to convert that bond to a stock if they think the stock's going to do better. So in some ways you have the downside protection of a bond, although again with a little bit less interest payment, but you have the ability to have some of the upside potential of the stock market. So it gives people a little bit of flexibility, which I know you like.
I do. Good thing to be included. So I'm going to assume that call options have nothing to do with a phone?
Call options have nothing to do with a phone, absolutely not. Callable bonds are bonds that are actually callable by the issuer, by the corporation. Just like, you know, when you have a mortgage in your home, if interest rates go down, you can always refinance at a lower interest rate. You could pay off the bank in full. And the same token, with a corporate bond, for example, when it's callable, it gives the corporation the ability to refinance at a lower interest rate. So of course, all else being equal, if you have a callable bond versus a non-callable bond, the corporation's going to have to pay just a little bit more interest for that privilege.
Which could be good for you. Now, you've said coupon a couple of times. Is that the interest rate the bondholder gets paid? Is that correct?
Yes. In fact, I want to talk about a couple of interest rates. The coupon rate is the stated interest rate that's right on the bond certificate or any of the other certificates for that matter, so that the person knows exactly what they're going to get each and every year, providing that the issuer doesn't go through any default of sorts.
Okay.
But there's actually another number that's more important. It's something called yield to maturity.
Okay.
Which takes into account the fact that you might be buying a bond at its repayment value or face value, or you might be paying less for it or more for it when you buy it. If you pay less for it, then your yield to maturity is actually higher than the coupon rate, because when it matures, it's going to be worth more.
Right.
And if you buy it at what's called a premium, where you're paying more for it, then your yield to maturity is actually going to be a little bit less than the coupon rate. So when you're looking at bonds, the yield to maturity is actually the most important interest rate, because it gives you the true economic rate of return between the time you buy it and if you assuming you hold it to maturity, combining the coupon rate as well as the change in price, the fact that you may have bought it at a premium or you may have bought it on sale.
Oh, that's a very important distinction. And preferreds, I know, are equities that have a set dividend. They're kind of like a hybrid between stocks and bonds. What is a BDC?
Okay, a BDC is actually called a Business Development Corporation. It's really a fund which lends money to smaller companies. So as a result, they're getting higher interest rates because it's smaller companies, but it doesn't mean that it has to be enormously high risk, because what a BDC will do oftentimes is they'll narrow it down to companies that take secure positions on the debt, or companies that, for example, won't take a second home equity line. In essence, you have a first mortgage on your house, it's considered more secure.
Right.
So you can get into BDCs that have a first lien on assets, and that makes them more secure.
Okay, and what's a REIT?
A REIT is called a real estate investment trust. It's basically the stock of a company that owns rental property. And the dividend that investors receive that flows through from the REIT is really a flow through of the net rental income after expenses.
Ah, who said fixed income's painful or boring? This Sunday is delicious.
What were you expecting, an ice cream headache after all?
No, this has been a lot of fun.
Well, good. I'm glad I was able to clarify it a bit for you, and I was glad that I made it fun along the way. And I also hope, most importantly, that I made it fun for you, our income generation viewers. So stay with us. We have to take a commercial break, and we'll be right back with more important information about fixed income investing.
Closing numbers on the markets today. At one point, the market fell as if down a well, over 700 points.
Apple shares are just getting hammered this morning.
We're down by between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate. We're red everywhere, essentially, down by 4-5%.
We're down over 16%.
Dow at the same time has fallen about 18%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
Finally, there is an alternative. Read David J. Scranton's groundbreaking new book, Return on Principle: 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. Learn the truth about Wall Street, the financial media, and the secrets they try to hide from everyday investors. This isn't just another book about investing. Working Americans who have lived through 2 major stock market crashes and the worst financial crisis since the Great Depression in the past 16 years don't need another book about investing. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Stop planning for retirement with your fingers crossed. Plan with confidence, knowledge, and peace of mind. Read Return on Principle: 7 Core Values to Help Protect Your Money in Good Times and Bad. Available now.
Earlier, when Mohamed El-Erian and I spoke, he said, "You cannot be the good house in a bad neighborhood." In other words, even while the United States economy is showing some growth, it can only improve up to a point when the rest of the world is faltering. Today, America is still viewed as the safest place to invest, and that's in large part what's keeping many of our interest rates low. I believe this might just be the new normal for interest rates for years to come. That is similar to Japan's interest rates, where we'll experience decades where yields remain well below average. But many investors who want the safety and promise of a known return in fixed income have been waiting. They're the proverbial deer in the headlights, and they've waited up to 7 years now because they're sure that higher rates are inevitable and just around the corner. They believe that higher rates are as certain as death and taxes, and they will eventually prove themselves to be correct. But in the meantime, they should consider exactly how much they'll continue to lose and never be able to recover under the more likely scenario. I mentioned Japan earlier. Take a look at this chart of Japanese interest rates for the last 25 years. You can see that in 1991 and 1992, they're around 6% or so. But they rapidly declined throughout the mid-1990s. The decline, in fact, was similar to the drop-off that we had back in 2008 here in the United States. Anyone in Japan that's been waiting for rates to go back up is much worse off now than if they had invested sooner. In fact, in the news just a couple of weeks ago, the Bank of Japan dropped one of their key interest rates even lower. The new interest rate paid is now a negative 0.1%. The reason their economy remains weak is that much of Japan's population is older and in the period of their life where people simply don't spend as much. Later in life, we naturally tend to make fewer big ticket purchases, which in turn has an impact on all other economic activity. This is why their rates have been low for decades, and Japanese stocks haven't recovered either. Now consider this. The age of the average person in the United States is about 10 years behind that of the Japanese population. If Japan's experience can be used as an indicator, it suggests that we might also be in for another 10 years or more of extremely low interest rates accompanied by a weak economy. Now, I personally have a lot of letters after my name. I call it the alphabet soup. Each designation represents a certain knowledge base or expertise that I've acquired. These proficiencies help when I meet with people that come to me for investment advice. But since 2008, one of the things I have helped people with the most every day is not covered by any of these designations for which I'd worked so hard. It's called atechophobia, or the fear of being wrong. Some worry that if they invest, say, 5 years at 5% today, and next year they could have gotten 6% instead, that, oh my goodness, they will have made a huge mistake. And they simply don't want to be wrong when they look back. None of my designations suggest that I'm an expert in helping people overcome fear, but in a way, they all suggest that I am an expert in math. And in this case, overcoming their atechophobia takes a moderately simple mathematics problem. And as I'll show you in a minute, you can invest immediately, and if rates do rise, they may still have made the best decision by investing now instead of waiting. Conversely, they could do nothing now and wait for a while on the sidelines in cash and be correct about interest rates rising, but find that they earn less money by being right. In other words, win the battle and lose the war. So if they're worried about being wrong, they could be right, and at the same time still be wrong. This will clear up any confusion, or at least I hope so. A year ago, a woman came to my office named Agnes. She had a $100,000 5-year CD, which had just matured and had been paying her 5%. Her bank's new rate for 5 years was only 2%. This amounted to $3,000 of reduced income each and every year. Now, this was a big negative for her budget. So I explained to her other types of fixed income options to help her where she could get something close to 5%. She knew she had to do something, but in our conversation, I learned that she was afraid that if she invests today at 5%, she was concerned that next year the rate might even be 6%. Then she'd be upset. The fear was going to keep her frozen and prevent her from doing anything. So I took out a piece of paper and I wrote this. 5% for 5 years on $100,000 pays you $5,000 a year of interest, for a total over the 5 years of $25,000. I then explained to Agnes that if she's right and rates are 6% next year, she should still invest today. I then went on to explain that if you keep your money in the savings account for the next year earning 0% and interest rates rise, in order to earn the same $25,000 of interest over that 25-year period, rates on a 4-year investment would then have to rise to 6.25%. Now, when I showed her those numbers, neither of us felt that rates would rise by quite that much. She decided that waiting was probably the wrong thing to do. So far, it's proven to have been a great decision for her. Earlier, although he was talking about banking authorities, Mohamed El-Erian said, with time, if you don't use the right tools, the collateral damage becomes significant. It's important to have the right tools or find a financial advisor with the right tools to manage fixed income. Neither Agnes nor her bank had these tools, so over time, she would have been worse off. The damage that some of their retirement accounts have suffered, because not all advisors have the best tool set, is one of the reasons I'm here each and every week. I want to help you, the income generation, understand that there are options that you may not be hearing about anywhere else. I want to take this opportunity to thank Mohamed El-Erian for his thoughts today. His brand new book is called The Only Game in Town. I'm now reading it for a second time, if that's any indication of the depth of insight you'll find between its covers. I also want to thank Morgan Thompson for all her help today. We'll see you back here again next week. And I want to make sure you at home know how much I appreciate the calls and emails coming into my office from you. For more information on today's subject, I just finished writing a report for my viewers called Renewable Retirement Resources, the case for fixed income. Go to theincomegeneration.com and download your copy after the show. You can also download my special report called The Income Generation. Well, that's the scoop for today. I'll see you all again next week.